Hello friends, welcome to my weekly market outlook video. Are you really prepared for the high volatility week that lies ahead, typically before the budget, and the even higher volatility that is likely to follow after the budget? Worry not, I'm going to look after all those queries and handhold you through this coming volatile week with in-house exclusive studies and indicators that have helped you so recently and so accurately. Even as I've sent you midweek and pre-session market updates via WhatsApp. Hey, first of all, I'd like to thank you for the overwhelming response that you've given me in terms of our updates, in terms of the number of views that you've given me to last week's video, and especially for the number of people who've gotten in touch with me wanting to be added to our WhatsApp broadcast lists. Guys, it's completely free, and do remember, I don't give individual stock tips. It's market gyan, but you'll be none the worse for it. You'll know what to expect in the market, as people who are already in the list will more than happily tell you. So if you want to be added to that list, do send an email to the ID that you see on your screen up there, and we'll get you going. So friends, the budget is almost here. On Tuesday, the finance minister will unveil what lies in store for us in terms of the amount of taxes that we have to pay and the SOPs that we can expect from the government ahead of the budget. So let's dive right into this video and see what happened last week so we can navigate and guesstimate as to what lies ahead for us. Coming up on your screen is the weekly market roundup. I'm very pleased that the markets behaved exactly along expected lines because the bulls were on the edge. And that's something that I mentioned to you last week as the thumbnail on your screen will tell you. Now, coming back to the roundup, you can see that the fall was led by the Nifty. Remember, the impetus chart of the Nifty was warning you in advance that the Nifty would be weaker than the Bank Nifty in relative comparison. Now, the Bank Nifty, on the other hand, managed to end the week with mild gains. Now, there is a lot of expectation or hope showing up in the charts of public sector banks. And their stock prices are basically bouncing hard and quick, even if there is a profit-taking decline in them. That tells me that the market either expects something to come in the PSU banks, or maybe there is actually something coming in there. So that suspense, the veil of suspense, will be lifted on Tuesday. Now, a rising US dollar kept bullion, which is gold and silver, under pressure because money moved to the relative safety of the US currency rather than gold and silver. A rising dollar, unfortunately, remains a big worry for us in the week ahead. And what's really surprising is that the rising dollar could not really subdue the price of oil and gas, which are going up due to geopolitical considerations. Remember, what you're seeing on your screen right now is a screenshot of my social media account, wherein I told you in the second week of early January itself that there are likely to be Saudi strikes against Hodeidah and Salif, these two port towns in Yemen, because the Houthis were attacking the other Middle Eastern countries from there. And sure enough, the Houthis have been claiming to have fired weapons at Dubai, Abu Dhabi, and Saudi Arabia. I expect the problems there to escalate. So that's going to be a red flag here. And Eastern Europe is another theater of tension for market players, where Russia is very keenly intent on cornering Ukraine, much against NATO and other Western nations' warnings. So the USD INR, which is the US dollar versus the Indian rupee, also gained strongly. Now, that is a pressure point because what we call as imported inflation, prices of anything that's imported will go up. Particularly crude oil and natural gas are exceptionally worrying because they trigger inflation in the broader economy itself. So everything from your mobile phones to computers, laptops, shoes, jeans, everything will get expensive. The 10-year benchmark bond yields rose to 6.74%. Now, I've unashamedly been at the forefront of warning you that bond markets can only be ignored at your own risk. And if you're a bank nifty trader or especially a banking stocks trader, never ever neglect the bond markets. So the bond markets were basically telling you that things are definitely not kosher because yields rose to 6.74%, which is the highest after December 2019. This worry, unfortunately, cannot be wished away. Now, this last week we saw the NSE market capitalization fall 3.8%. Now, remember what I told you in the last week's video itself, that any decline in market capitalization over 4% in a week is a sign of worry. Because historically, we've seen whenever market cap falls more than 4% for a week or two, it leads to a much bigger fall. And this is definitely not good news for the bulls. Now, this week onwards, I've included the US indices because the undeniable impact that they have on our markets. All three indices, the Dow, the Nasdaq, and the S&P 500 rallied on a week-on-week basis thanks to the late gains. Had it not been for Friday and the price action that we saw on Friday, I think all three indices would have suffered declines. Now, the fact that these three indices rose on Friday may see brakes being applied to the declines in our market, at least if not a decline, an attempt by the bulls in the initial part of the week to stop the decline or maybe even push prices higher. Of course, the ultimate trigger will have to be the budget. Observe the MWPL chart on your screen right now. I posted on my social media accounts that I expected a lower peak in MWPL in the January futures series, and it panned out exactly along my expected lines. The peak of the MWPL was at 29.65%, which is a good 4 to 5% lower than historical averages. Now, this shows that traders are going into the budget session with low expectations. Actually, come to think of it, I see that as a minor mercy because if at all the markets fall post-budget, it may not be as sudden and as vicious as it would have been if there were huge positions built up by way of MWPL going past 34-35%, which would obviously be offloaded in a panic if the market expectations were not met. However, let me caution you, it's early days yet. Markets in the budget period are known to surprise traders, not always pleasantly. So, watch this figure of MWPL very, very keenly. If you do not have the hard data about MWPL, worry not. I post it on my social media accounts every day, so you can just connect with me and update yourself day to day. My contact coordinates will come at the fag end of this video. The index and stock futures turnover chart shows the volumes actually collapsed on Friday. This is not a good sign because Friday was a bullish day. The markets actually pulled up from intraday lows. So what you can see on your screen was the volumes have jumped on bearish days. Even if you discount the fact that rollover were taking place, the volumes go up on rollovers because people square up the January futures and initiate exposure in the February futures. So the impact is dual. Even if you discount that fact, volumes were high on days that there were declines. Now, this volume figure is also something that I post on my social media accounts, as you can see on your screen. Now let's go to the basis chart, which you can see on your screen. It's nothing but the premium enjoyed by futures over spot. This is another rough and ready gauge of risk appetite. Basis jumped on it after expiry because the new series gave traders 4 full weeks to play around with in the market. And on Friday, basis fell because selling and some hedging pressurized the market into surrendering part of its premium. Now, do note over a period of time decay usually sees basis fall. So, in the coming days, don't be surprised if the basis starts to fall. Do note if the basis actually falls too sharply. Now, here again, this is something that I update on my social media accounts. So, don't worry. Even if you don't know how to compute this, we've got you covered. Now for the most robust indicator I've shared with you so far from our array of in-house exclusive studies, I'm talking of the impetus chart. As you can see on your screen, it shows while the Nifty continues to remain under pressure, the impetus continues to rise, which means it will take a lot more heavy lifting on the part of bulls to get Nifty going above this recent high of 18,600 again. A short covering pullback rally may always be triggered at any given point in time by news flow. But ideally, if the rally is to sustain, the price and the impetus must rise together for sustainability. Let's now see the Bank Nifty impetus, which shows that the impetus is actually falling, even though the price-wise Bank Nifty index was rising, which means that this is a minor red flag. People are not really convinced about the Bank Nifty's impetus. Some of my viewers have reverted to my WhatsApp update of Wednesday, 26th of January, wherein I shared the first study from our in-house statistical model, the IBEX. Do remember that rollouts of new studies will always be soft in nature. By soft, I mean first, it will go as WhatsApp messages, and then over a period of time, it will appear in the weekly video shortly thereafter. So, a reminder, in case you want to be included in our WhatsApp broadcast list, do send me an email on the above mentioned mail ID, and we'll get you going immediately with our free updates. Now, the query was why I didn't take the advanced decline ratio and preferring to take the chart of the market capitalization instead. My answer, my friends, is very simple. I prefer to stay ahead of the crowds. As a matter of fact, this is one burning driving point of IBEX and the way the thought process is going in the IBEX. We would want to be ahead of the market, even if it means appearing to be wrong in the short term. That's fine. The reason why I took market capitalization is because I want to avoid the con games that are played in the markets by big money. Now, take for example, what if the price of a stock was to go up only by 5 paise, just by 5 paise? Your advanced decline ratio would tell you that X number of stocks advanced. Is it really an accurate picture? Because operators can do that. They can push up the share, say by 5 or 10 paise, and you'd think the stock market is rising. But what about the total capitalization, the value of the increase in share prices across the market? That would be zilch, almost zilch. So, to be able to take the bigger picture more effectively and statistically, I've taken a derivative approach of the capitalization. So this, I hope, answers your query. I basically wanted to ensure that you don't get sucked into any bull or bear traps by depending only purely on the advanced decline ratio. After spending 36 years in this market, it would be a crying shame if I was to fall in these childish traps. Now let's see what the 4 categories of traders have been doing in the markets last week. Let's measure their footprints, starting with the FIIs, where the index futures are concerned. They were net short to the extent of 63,671 lots, which was last week at 381 lots short. Where stock futures are concerned, their net long positions have dropped sharply to 26,096 lots, which last week was 51,757 lots. Where clearly, my friends, FIIs are unwinding their long positions. Let's see what the DIIs are doing, the domestic investment institutions. Their index net shorts went down to 40,853 lots, which was last week a net short of 43,299 lots. Where the stock futures net shorts are concerned, they went up to 16,49,412 lots net short from last week 16,22,465 lots net short. So the DIIs continue to press sales. Where prop traders are concerned, these guys are super sharp traders, second best only to insiders because they are brokers. They take their own proprietary trades, so they know who's buying and selling. Their index net long futures went up to 23,775 lots, which last week was 1,509 lots. And where their stock futures are concerned, they increased their individual stock futures net long positions to 2,10,325 lots, which last week was 1,92,215 lots. So the prop traders, the sharp, smart money is increasing its net long positions, although mildly, but definitely it is increasing. The last category, retail traders, people like you and me, where the index net futures long positions are concerned, they went up to 80,749 lots, which last week was 42,171 lots net long. The individual stock futures net long positions shot up to 14,12,991 lots, which last week was 13,78,493 lots. So it's very clear that the retail guys have been doing all the heavy lifting. They've been responsible for the most amounts of new speculative fresh long positions being initiated in the leverage space, which I think is a cause for concern because it might trigger volatility due to the simple reason that as long as the market is going up the direction that the retail guys expect, there's no problem. Should there be any surprise adverse announcement in the budget and the individual retail trader starts to unwind, the quantity of selling can be big enough to trigger even higher volatility. So that is one thing that you need to remain concerned about, which is why I keep telling you on my social media posts, trade light and keep stop losses. Friends, let's now go to the 10-year benchmark bond yield, the most important aspects of the market, because this segment is what arranges the money or provides finance for other asset classes in the market. And if you're a bank nifty or a banking stock trader, you will ignore the bond yields at your own grievous peril. Now, the Indian 10-year benchmark bond yield rose to its highest after December 2019 as the US Fed kept rates unchanged for now. But as I updated you via a WhatsApp message recently, asset purchases will be wrapped up by March and rates can rise thereafter. England may lead the way for large economies in raising coupon rates on this side of the Atlantic. Cash carry trade, which is money leaving those economies where interest rates are lower and getting invested itself into those economies where interest rates are higher. The cash carry trade will ensure that other countries will be forced to raise rates if one of the four major Western economies increase interest rates. Emerging economies, especially in Latin America and parts of Asia, are already jacking up rates. It's a matter of time. The big economies also do so. Now, this will raise the cost of funds worldwide. India also will have to offer higher interest rates, which I believe may be triggered only after the election in the coming months when the MPC or the Monetary Policy Committee of the RBI meets. I think my viewers should have allocation to bonds and fixed income investments, preferably government guaranteed fixed income investments. As I updated you in the WhatsApp update, why do I always say sovereign guarantee, government guarantee? Because only the government has the authority to print money. If push comes to shove, if there is a problem in repaying, which is very rare, but if at all, God forbid, there is any problem in repaying the money, only the government can print money and repay its investors. Private parties cannot do that. So even at the risk of taking very small difference in the yield on government guaranteed sovereign investment schemes, I sleep better in the night because I'm ensuring that my family gets return off and return on capital both. So that's a trade-off which I prefer to take. Now, I've been suggesting that you resort to what is known as laddering on fixed income investments on my social media accounts since many months. And I continue to advocate doing the same. As a matter of fact, I believe post-budget scenario will be good for fixed income laddering, though the yield tail flipping is some time away. That is what something a fixed income investor does when he feels that rates are either topping out or have already topped out. So if my statistical trading models are correct, I think this will be a major differentiating factor between just another trader and an above average trader in 2022. Now, long-term investment views in equities appear to be sexy, but why go down with the markets when you can unplug from it and salt away some funds in fixed income? Markets are like a chessboard, and your money is like the pieces that are on the chessboard. Now, how you move your pieces, which is your money, will determine how well or otherwise you will do in this game. So, you can definitely take out some portion of your money from equities and go into sovereign guaranteed investment schemes so that, number one, you avoid the decline in portfolio. Even though notional, you may not be booking the loss, that's fine, but you would be saving yourself that decline and earning some alpha by way of interest on this. That's my ulterior objective. So please move your pieces well. I'm not telling you to shift 100% out of equities. There is no such thing as 100% off or on. So a partial shift will do. Friends, let's now go to the Dixie, the US dollar index, which gained 1.65% on a week-on-week basis and rose on 4 out of 5 trading sessions last week. The round number hurdle of 97 has been overcome. The geopolitical stress in Europe and Middle East, North Africa has seen flight to safety in the US greenback. As you can see on your screen, the price is above its 25-day exponential moving average, which is approximately a month-long holding on cost of an average bull. So the short-term outlook has improved for now. The weekly chart on your screen tells me that the price has scaled levels not seen after June 2020. This has implications for emerging markets, including India, where weakness in domestic currency pegs will trigger what we call imported inflation. The price has been above its 25-week exponential moving average, which is a 6-month holding on cost on your weekly chart. So the medium-term outlook is positive for now. Last week, I advocated a range between 96.65 on the upside and 94.65 on the downside, which was overcome on the upside because of the geopolitical factors that I mentioned to you in Yemen and in Ukraine. So the coming week, I expect an estimated range between 98.30 on the upside and 96.15 on the downside. Do watch this benchmark very keenly now that we are headed into the union budget week. Friends, I now go to the Bank Nifty, which managed to save the day by rising 0.31%, and it rose on 2 out of 4 trading sessions last week. But the bullish sessions, though 2 out of 4 only, were strong enough to result in net gains on a weekly basis. The price has moved up above its 25-day exponential moving average, as you can see on your chart, which is a month-long holding on cost of a bull. That means the short-term trend is positive for now. A clear uptrend may become a possibility only after the previous swing high of 39,000 is overcome sustainably on a continuous closing basis. Let's turn to the weekly chart on your screen now, and what we see is a long leg doji which is formed on the weekly chart. Now this is formed when the open and close are fairly close to each other and both are in somewhat of a center of the trading range. This indicates indecision or even a draw between bulls and bears, and therefore follow-up action is absolutely critical for trend determination of the near term. The price is above its 25-week exponential moving average, which is approximately 6-month holding on cost of a bull. That means the medium-term outlook remains positive for now. In the week before last, this index was number 10 on the most volatile list, but it fell to number 12 because individual stock futures gained volatility in relative comparison with the Bank Nifty. Last week, I advocated an estimated range between 39,250 on the upside and 35,900 on the downside, which held perfectly well in spite of all the volatility. The coming week is likely to see an estimated range between 39,400 on the upside and 36,000 on the downside. Now, this range has a fair probability of being exceeded in either direction due to the budget factor. We do not know what lies in store for us, so please trade light and always keep stop losses on your trades absolutely diligently. Friends, I now go to the Nifty 50, which lost 2.92% last week, and it took the brunt of selling. The fact that it's a broad-based index with 50 individual stock constituents tells me that the sell-off also seems broad-based. That is denoted well by the fact that the NSE lost rupees 8,51,089 crores in the last 4 trading sessions. Mercifully, it was a holiday shortened week. Now, the market capitalization based derivative study is what I shared with you on WhatsApp on Wednesday last. This study will be a regular feature in my videos in the very near future. Now, coming back to the Nifty, the daily chart we see on screen saw the index fall on 3 out of 4 trading sessions. The price remained below its 25-day exponential moving average, which represents a month-long holding on cost of a bull. And that tells me that the near-term trends, the short-term trends appear to be under pressure. This week's significant low, which was at 16,837, give or take a little, will be a Maginot line for the traders. Should this be violated conclusively and forcefully, I expect declines to accelerate. On the flip side, any sustained trade above 17,700 will energize the bulls. The levels may seem to be broad and wide, but please remember, we are in a budget week. And as we turn to the weekly chart, we see a second consecutive bearish candle, which has closed below its 25-week exponential moving average, which is more or less a 6-month holding on cost of a bull. That means the medium-term outlook is also under pressure. Do note that the price is closing below its 25-week exponential moving average after June of 2020. That's a major corrective decline for traders who've grown accustomed to the idea that the markets can only go one-sided, that is, upwards. The October peak which was made above the 18,600 level remains inviolated, means remains untested, even though the markets rallied in 2022. Also note what I maintained earlier, that the impetus for the Nifty is hostile to bulls and the market-wide position limits, the MWPL, remain subdued, which tells me that there's lower risk appetite out there. What is immediately apparent is a crossroad in prices. Either better than expected budget will be announced and the doubting Thomases will jump onto the buy side, or the doubting Thomases will be proved right and the markets will fall sharply. Either way, one thing is certain. Statistical beta, which is the pure price volatility, will jump through the roof next week. Now, most retail traders are not geared to handle this kind of volatility. You may not like me saying this upfront, but hey, just because it sounds harsh doesn't mean it's not the truth. Let's be extremely careful, and let's face it, this volatility is not something everybody can handle. In the week before last, this index was number 16 on the most volatile list, but it jumped 5 places to close at number 11 on the most volatile list last week. Now, this is because of extreme price mobility of the Nifty. Do remember how it was making 200, 300, 400, 450 point intraday moves. That's unheard of. I warned you about the Jensen's measure last week being absolutely hostile for fresh buying. That statistical hypothesis was proved 100% right last week. I also sent out a message to you friends on Thursday about what to expect in the last 75 minutes on Friday. This was based purely on our in-house statistical studies, and do note how the markets moved like fitted the kind of trading pattern like a T to our expected movements. Now, the statistical beta, which is pure price volatility, is likely to stay elevated or maybe even go up higher. Now, that's jaw-dropping, believe me. Stay on the guard, please. And last week, I estimated a range between 18,200 on the upside and 17,000 on the downside, which was violated because the low was 16,837. In my defense, I'm not making excuses. In my defense, I did warn you that due to the extremely high statistical beta, we might just see volatility that will go off the charts. So this was a kind of expected. And where is the volatility? The beta, believe me when I tell you this, is near a decade and a half high in many, many stocks. That's 15 years. Beta is at 15 years or higher levels as compared to what you have seen even before the 2008 collapse. I'm not saying that the markets are collapsing. I'm just saying that the beta has gone up. So do differentiate that, know what the difference is. And that beta only got worse last week, and the coming week may see a violation of the range which I'm about to advocate, which, by the way, is estimated between 17,725 on the upside and 16,450 on the downside. Do remember, it's not cast in stone due to the budget's volatility, and stay light and maintain stop losses very diligently. Jensen's measure, the Traynor measure, the Kelly's criterion are all not in favor of aggressive fresh buying in the leverage space. So be extremely careful out there. Friends, the index is done. I get to the most popular segment of the video wherein I give you 5 stocks, high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks, low beta, low impetus, where you take big exposure, wait for small price moves. Why the difference? Because different traders, different mindsets, different aptitudes and attitudes, and therefore, hey, the strategy's got to be different too. So the high beta, high impetus stock list is led by Torrent Pharma at number 1, Astral at number 2, Pidilite Industries number 3, number 4, Deepak Nitrite, and number 5, Dixon. The low beta, low impetus list where you take big exposure, wait for small price moves is led by Motherson, Sumi number 1, number 2 PVR, number 3 HAL, number 4 AU Credit Bank, number 5 Muthoot Finance. Friends, this hierarchy of low and high beta stocks changes from day to day, and do connect with me on my social media accounts where I update this data every day. And we'll help each other become better traders, share a lot of market intelligence and hand holding. And I put up a lot of content there, which is very easily grasped even by a high school student. So even though I use the word statistical data, don't get intimidated. The idea is to make it absolutely simple. Friends, before I draw the curtains down on this video, humble request, please subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. Good, bad or ugly, do let me know your feedback in the comment section. I'd love to hear from you. And please help me reach out to a bigger audience as you have last week by referring my videos to your family and friends. Also, in the description below the video is a link to my playlist in Equity Masters YouTube channel. Do subscribe to my playlist there, wherein I put up 2 or 3 ideas every week. And there's also a link to a free trading guide from Equity Master in PDF format. Do avail of this fantastic opportunity. Thank you for your patience, friends. I wish you have a very, very profitable but volatile budget week of trading ahead. Do take extra care of your finances. Thank you for your patience. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.